You've likely watched 100 videos on a compound interest calculator. You have likely heard 1,000 times, if you invest into the S&P 500, $1,000 a month, over 30 years, you'll be a multi-millionaire. After those 30 years, you'll have generational wealth. They average out the nominal returns at 9%, CPI inflation is 3%, so your real return is 7%. This is a lie. The truth is, CPI is the cost of surviving. Are you wanting to be a survivor, or are you wanting to be a capitalist? See, capitalists, they track their wealth against the money supply. This is the actual cost of assets. If your goal is to be rich in bread, milk, and eggs, then track CPI. CPI is for survivors. But on this channel, we're capitalists and we track our wealth against currency debasement, which averages around 7%. This completely changes your entire worldview on investing, because it's the truth. Because if you want to be rich in land, gold, prime real estate, and real assets, you track the M2. M2 is all the new currency that has been issued, new US dollars, that we can track. Why is this so vital to understand? Right now, the US government is running a massive deficit. There is no way out of this deficit apart from currency debasement, M2 inflation, and financial repression. There is no way they can tax their way out of this. There is no way to cut spending. There's only one solution, and that's M2 inflation. Let's look at the real returns of the S&P 500, projected over the next 10 years. Your nominal index average will be 9%. M2 true wealth average 7%. This means your actual pre-tax return is only 2%. 2%. So net of tax is only a measly 0.65%. You see, diversification is diluting the wealth. Because what people are trained to believe is that having, individual companies or stocks or a concentrated portfolio is high risk. It does not need to be high risk. It depends on the assets. But to dollar cost average into the S&P 500, especially at the current valuation, let's look at the numbers right now. The S&P 500 went up about 17 to 18% over the last 12 months. And monetary inflation is actually sitting right now only at 3.4%. So currently it's low. So this looks like the S&P 500 is vastly outperforming inflation. But don't get your hopes up yet, because the truth is, whenever the S&P 500 outperforms the monetary inflation or the M2 supply, it normally means the market is overvalued. And that's exactly what it is right now. Vastly overvalued and dominated, of course, by the Mag 7. Massive extreme multiples expansion. Think of the M2 money supply and the assets of the S&P 500 like an elastic band. The elastic band stretches, and that's the valuation of the S&P 500 running away from the money supply. Eventually, it's going to snap back and pull that down and pull it back to reality, because it cannot run away ahead of the money supply for so long before this will correct itself. So let's talk about volatility. People believe volatility is risk. This is a complete lie. Risk is permanent loss of purchasing power. If you have $100, it has zero volatility, but it has maximum risk because there's guaranteed loss of purchasing power. Because more and more dollars are going to get created, the value of your dollar is going to get less and less. If you owned a stock and every single month the company kept issuing more and more stock and diluting your stock, you would be very unhappy. It's the exact same when it is applied to a currency. Let's look at Microsoft I'm going to use this as an example. The way that you should frame your mind towards an investment. I want you to imagine for 12 months, Microsoft stock price remains completely flat. So if you were to look at it from January to December, 0% nominal growth in the stock. So we're all unhappy. We think it's underperformed. People go online and complain. They ask for explanations on Reddit or the internet, and everyone is unhappy, and people sell their stock because they think, oh, I could have got 20% return if I invested in Google or someone else. This is the wrong way to view an asset. Let's look at the actual cash flow. So if the cash flow is growing at 20%, between 20 to 25% growth, revenues are going up, net margins are going up, the company's performing fantastic. Let's just imagine the PE ratio is 20, growth at 20%, so the PEG is 1. The company continues to pay a dividend and it continues to buy back its shares. What we think is the stock has not outperformed monetary inflation just because the stock price hasn't caught up. This is false. It's absolutely outperforming from a cash flow perspective. But from a nominal stock price, it's not. This is a coiled spring. Eventually the market will correct this. This is how the greatest investors view their stocks. They stop looking at nominal growth. Because if you're so focused on nominal stock price, this is why you get trapped in the compound growth calculators of the S&P 500. But really what's actually happening, their assets are not going up. The dollar is just getting weaker. The same can be applied for real estate and all other asset types. This should completely change your worldview on investing and what your hurdle rate is. Because we are not survivors. Our goal is not to survive. Our goal is to thrive. Capitalists and investors, this is how we do it. You see, the misconception is you're an investor if you are investing into the S&P 500. The reality is you are a saver. An investor has a more attitude to a concentrated portfolio, and they understand what they're invested in, and they understand looking at the company's fundamentals and its cash flow growth. That is what truly matters. So if you want to be an investor, this is your new hurdle rate. If you're happy to be a survivor, continue to track the Consumer Price Index.